Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Dover Corporation, ticker DOV. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, this company has a market cap of $18 billion, enterprise value of $20 billion, so you have about $2.5 billion in net debt on the business. There is some leverage here, but it doesn't appear significant compared to the market cap. Now, you do have the machinery industry. They provide equipment and components, consumable supplies, aftermarket parts, software, and digital solutions worldwide. They have engineering product segment, various equipment component used in aftermarket vehicle service. Aftermarket parts tend to be a pretty good market segment, depending upon the competition level. Usually you're able to get a decent amount of pricing when you sell aftermarket parts. They also have a clean energy and fueling segment. They offer component, equipment, software, solutions. Let's see, vehicle. So they have the image and identification segment, precision marking and coding. They have a pump and process solution segments, climate sustainability technologies. So basically this is definitely in the auto industry, but machined parts for the auto industry. The auto industry, everything that goes along with that, there's very high volumes in the auto industry, very diversified part suppliers. But certainly if you're selling aftermarket parts, that segment might be actually quite good. So you could get some nice returns on capital. We'll see how that plays out. The beta is quite high, 1.3. So it tends to be just a little more volatile. It would be a sign, not necessarily of a low quality business, but it's not a sign of a high quality business. You'd prefer a lower beta. Now, what I like when I get down to this return on invested capital chart is instant look. You can instantly see a few things here. One, they're profitable. They've been profitable every year for the last 19 years. That's a very good sign. And two, they're hanging around this 10% return on invested capital chart cap number. You don't see a lot of volatility here. Now, it does dip down from 2007 down to 2009. It gets back up by 2011. But for the most part, you're bouncing around 10%. You're not seeing losses. You're not seeing it dip down. You're not seeing these big waves. So although there's some minor cyclicality here, it's jumping around a little bit. It's not cyclical. This does not appear to be a cyclical business. It seems to be pretty steady. You're pretty steadily earning 10% return on invested capital. You had a really good number in 2021 that could distort some of the profitability metrics depending upon how reliable that is. But for the most part, I like what I see here. Hugging the 10% line on return on invested capital is a very good thing. I don't mind you dropping below that, especially if you don't lose money, especially when you offset that with other good years that are above it. So I like what I see here on return on invested capital. This is a sign of a quality business. What I want to see with my returns is a 10% plus return on invested capital. You have that. You're at 10.8%. I want to see return on equity above 15%. You do have that. You're at 19%. And where's that coming from? That's coming from your leverage. You have some leverage here. This is that $2.5 billion of debt here. So you have some leverage, and they're allowed to leverage the business with that. And that's actually providing a good amount of leverage to give you sufficient return on equity to make the business quite profitable. Now, along with that, everything here is showing, hey, quality business on these returns. In addition, we're seeing the valuation be quite reasonable. I like to buy stocks at a PE of 15 or less. PE of 15.7, PE of 16. That's basically what I'm talking about here. So it looks like the company is reasonably priced. So you're getting a high quality company at a reasonable price. Now, why is that? We're going to have to figure it out, but it looks like the reason might be due to low growth. So you have revenue growth of 0.7%, asset growth of 0.9%. If we just round up and say that's 1% growth, that's very, very slow growth. This would suggest a company that's not growing steadily, certainly, and seems to be kind of trapped out at a max market. You can earn good money with this, but this is something I would hesitate to invest in because although it's a good valuation and a good return on capital, you're going to be basically trapped by your EPS growth, free cash flow growth, but you're not going to get outstanding returns. You might get good returns, but not outstanding returns. And what we're going to see here is that you're going to trend towards this revenue growth rate over time, regardless of what you're able to do on the operating basis. Now, the EPS growth rate is higher. I'm going to guess that is because maybe they're buying back shares. We'll have to see. But you can instantly see what's going on here. I mean, you have $6.6 billion in revenue in 2012. You end 2020 with $6.6 billion in revenue. So you're basically flat over the course of 8-9 years. You did jump up again in 2021, but you can see you've been at the 7 billion range before. You got up to 7.7 billion in 2014 before trending down again. This is just, it's not a secular growing business, which makes it really hard to get very, very high rates of return. Now, you seem to still have done well. You've gone from $4.40 EPS to $7.74 per share. So it has been good there, but it's not great. Now, we need to see in the income statement a little bit more to understand what's going on to get that 5% EPS growth, because it's not obvious on this part of the statement. If you're enjoying this video, hit that like button. Don't forget to subscribe. Your likes and subscriptions help tell YouTube you're enjoying my content. That's the best way that you can support the channel at this time. So, income statement. So, you can instantly see that I was right. When you go down here to shares outstanding, you have 184 million shares outstanding to begin the decade. You end with 145 million shares outstanding. So you've retired about 25% of the shares outstanding over the course of the decade. That's going to give you that 2 to 2.5%, 3% boost in EPS over time. So where are we going to get that? It's going to basically go from 1% to 3 or 4%, and then maybe you get another percent from operating leverage. So pretty explainable that the buybacks are driving that return. But overall, the net income number is basically flat. You're at $1 billion in 2013, $1.1 billion in 2021. Nothing exceptional here in terms of growth, and that's a little unfortunate. Although you have good returns on invested capital, it's clear that you can't reinvest the money. And without reinvestments, you're not going to be able to compound your profits as a shareholder as much. And that's a problem. So now, what's good news is you're not been growing your assets either. That's actually really good news. You're at 971 million in PP&E, 957 to end the decade. Pretty good. You don't like to see that growing if revenue can't grow. They've grown debt a little bit. That little extra leverage probably allowed them to get a little bit of higher return over time. Cash flow statement. You can see the slow and steady buybacks. It's a good use of cash. Slow and steady dividends, good use of cash. Capital allocation here is fine. So the problem that you're going to have with this company is just that it's not growing. So your return as a shareholder is going to be capped by your earnings yield plus your return on equity. So return on equity is 19%. You're not going to get a 19% return because you're not reinvesting your capital. Okay. So then you become earnings yield plus revenue growth is probably going to be what you get. So earnings yield here is 6%. Revenue growth of, let's be generous, 1%. 6 plus 1 is 7% returns. I think that's probably what you can expect with this company. This is probably a safe way to get 6-7% returns, maybe a little higher if the future's a little better, over the course of the next decade. If you're looking for something like a 7% returning stock, then Dover Corporation could be quite interesting to you. My personal investments, I want to see 10, 12, 15% rates of return. So for me, the company is a pass. It's good on quality, it's good on valuation, but the revenue growth is simply too low to give me those double-digit rates of return over a long period of time. So I'm going to pass. But if you want a high-quality company with a lower rate of return, this might be one for you to consider. I hope you've enjoyed this video. Hit that like button. Don't forget to subscribe. If you check out the playlist at the top, it'll show the past 140 S&P 500 companies that I've already covered. I think you'll enjoy those. I've covered quite a few that I think are really, really good buys, so I think it's worth taking time to check that out. If you like this software and you want to support the channel, consider going to sign up for quickfs.net. You can get a free or a paid account. And if you use the affiliate link in the description below, it's the first link in the description, then I would receive a commission if you sign up using my affiliate link. I hope you'll consider doing that. That's a great way to support the show. No extra cost to you by using my affiliate link versus going there directly. It's just letting them know I sent you and a small thank you back to me for having done so. I use the software myself. I hope you'll enjoy it. Thank you for listening, and until next time, start paying fees, start building wealth.